Welcome to the fourth video in our risk management series. In this video, we will focus on financial risks, a crucial aspect of managing global business operations. Financial risks can arise from uncertainties in currency exchange rates, inflation, interest rates, liquidity, and credit. I'll explain these types of financial risks in more detail, provide examples, and explore how these risks differ in various regions like the United States, China, and Latin America. Finally, we'll cover general strategies to help mitigate these risks and safeguard your financial performance. What are financial risks? Financial risks refer to the uncertainties in financial markets that can affect a company's operations and profitability. These risks include foreign exchange risk, when the value of a company's foreign earnings fluctuates due to changes in currency exchange rates. Interest rate risk, changes in global or local borrowing costs that impact the cost of debt. Inflation risk, the effect of rising prices on purchasing power and costs. Credit risk, the possibility of non-payment by foreign customers or business partners. For international companies, these risks can be compounded by capital flow restrictions and repatriation challenges, especially when doing business in certain countries. Let's look at some real-world examples that highlight financial risks. First, currency volatility. Imagine a U.S. company selling products in Brazil. If the Brazilian reais weakens significantly against the U.S. dollar, the dollar value of Brazilian sales shrinks. Many multinationals faced this risk in the late 2010s when countries like Argentina, Brazil, and Turkey saw their currencies swing wildly. Scania, the Swedish truck maker, encountered a similar situation in Argentina during the hyperinflation and currency collapse from 2018 to 2020. Scania's solution was to price local transactions in dollars and adjust its financial operations to mitigate the currency risks. By using this strategy, they managed to maintain value despite the volatile peso. Second, interest rate risk. In 2022, the U.S. Federal Reserve and other central banks raised interest rates to combat inflation. This rapid increase in interest rates increased the cost of borrowing for businesses, especially those with foreign-denominated debt. Many emerging market firms with dollar-denominated loans faced higher expenses as the value of local currencies weakened, making it harder to service dollar debt. Companies that anticipated this risk locked in fixed-rate financing or kept debt in local currencies to avoid exposure to rising interest rates. Third, capital flow restrictions. Countries like China and Nigeria often impose capital controls, limiting the amount of money that foreign companies can transfer out of the country. For example, in China, companies may need special approvals to repatriate profits, which can cause cash flow issues. In such cases, companies have to find creative ways to extract funds, such as reinvesting locally or using intercompany loans. Regional nuances. The financial risks you face can vary significantly depending on the region. Let's explore some key differences in the US, China, and Latin America. 1. United States. In the US, foreign exchange risk is one of the primary financial risks for companies. The US dollar is strong, so when multinationals earn foreign income, it may lose value when converted back into US dollars during periods of dollar strength. Inflation and interest rate risk are also factors, as seen in the inflation spike in 2021 to 2022. The US offers advanced financial tools for managing these risks, such as derivatives markets for hedging. But businesses must also navigate complex tax regulations that can impact overall financial strategy. Number 2, China. Financial risks include currency risk and capital controls in China. The Chinese yuan, renminbi, is not fully free-floating and is controlled by the government. This means that companies often face challenges when trying to repatriate profits. During the 2019 US-China trade tensions, the Chinese government allowed the yuan to weaken against the dollar, which impacted many businesses' costs and profits. Regulatory financial risks also exist in China, as businesses may face unexpected fines or back taxes due to compliance issues. Companies often use natural hedging, matching local costs with local revenue in yuan to mitigate these risks. 3. Latin America. Latin America is notorious for economic volatility, making financial risks a top concern. Currency fluctuations are common, with currencies like the Brazilian reais, Mexican peso, and others often experiencing significant swings. High inflation in countries like Argentina and Venezuela can complicate pricing and cost management. Companies must deal with the challenge of deciding whether to price in local currency, which can devalue, or in stable foreign currencies like the US dollar. Sovereign risk is also a concern, especially in countries like Argentina, which has defaulted on its debt multiple times. Now, let's discuss some common mitigation strategies to manage financial risks. 1. Hedging currency risk. Companies can hedge FX risk by using financial instruments such as forward contracts. For example, a U.S. firm expecting to receive euros in 6 months can lock in the exchange rate to eliminate uncertainty. Natural hedging is another approach, where companies match costs and revenues in the same currency to offset currency fluctuations. Number 2. Diversifying currency and banking exposure. Holding cash in multiple currencies and banking across different countries can reduce risk. This ensures that if one currency weakens, the entire financial system of the company isn't impacted. However, this needs to be balanced with efficient cash management. 3. Interest rate and commodity hedging. Companies can use interest rate swaps or commodity futures to lock in borrowing costs and input prices. For example, airlines often hedge jet fuel prices to manage fuel cost volatility. 4. Credit risk management. When dealing with international customers or suppliers, companies should secure payments through letters of credit or export credit insurance. Additionally, companies can reduce credit risk by diversifying their customer base, avoid concentration, and using reputable banks for financial transactions. Number 5. Compliance with financial regulations. Some financial risks stem from non-compliance with financial regulations. Companies need a robust compliance program to prevent violations of sanctions, anti-money laundering rules, and anti-corruption laws, which can lead to heavy fines. 6. Reserves and financial agility. Maintaining liquidity is key. Companies operating in volatile regions often keep extra cash reserves or have access to emergency credit lines to handle unexpected financial shocks. They may also practice financial agility by adjusting cash flows in response to market changes. In conclusion, managing financial risk in international business requires careful planning, flexibility, and the right financial tools. By using strategies like hedging, diversifying currency exposure, and maintaining strong liquidity, businesses can navigate the complexities of global financial markets and safeguard their profitability. If you found this breakdown insightful, don't forget to like, share, and subscribe for more updates on finance, risk management, global economics, and international trade. Thank you for watching.